Good afternoon. Welcome to Chicago Future of Finance. I'm Oliver Rennick. Thanks for tuning in. It's a special Monday show. There's international intrigue. There's drama in the commodity markets. It's a bit of a he said, she said market. Trump said, Iran said, fake news this, maybe not. Futures up, futures down, futures back. And right now we're heading into the close. I think pretty accurately holding on to the yellow across the board, range bound. Now, when we were under 66 on Friday, if I were here, I probably would have flipped that light red because that was the key line in the sand. But that's one of the benefits of having a day off is you don't overtrade. I think a lot of people are probably overtrading right now. That generally is what the he said, she said market means. That's a very exploitative type of trading. It's a very risky trading because you don't know anything about it. Trust me, you don't. You don't know what's going on over there. You're not an expert. You don't know what's going on in the war room. You got no idea what Trump's going to do. How many years are we going to do this before people figure out that it is extremely difficult to trade President Donald Trump? And generally, geopolitics as a whole are those buying opportunities. Here's the chart for the S&P 500, holding 66. Really fighting for it. That's the futures. Let's go to the index where I've got the line. You can see this line had support in November last year, had September, early September last year. We had a real ugly day below it last week. Maybe that was sort of the throwing everything out moment, but generally the market is holding on at the key levels. So yellow, I mean, there's just so much range-bound activity in this market. I feel that this is just the way to think about it across the board. I mean, what are you looking for? You're worried about the bond market? Possibly. I'm not so much until we get worse data. We just really still haven't seen bad economic data. We had a few numbers that came in light. There are some things Powell talked about in terms of job creation that are notable that could be of concern. But just keep in mind that a month and a half ago, really at the beginning of the year, I was looking for bonds to sell off already. Not because of inflation scares. And actually there is some very tricky logic you have to go through to figure out if yields should be going up or down based on inflationary scares. And it gets very murky. So the bottom line is right now the 10-year at 4.3% is definitely higher than it was, obviously coming into this month. And we've seen that blow out in relationship to this event. So it's not the good type of bond selling you want, but I'm just not too concerned about it yet. I'd be much more concerned if people were buying bonds because of fear for the economy. There's all types of stagflation conversation again. I'm so tired of it. It's so dull. It's so incredibly dull, I gotta be honest. We've been having this conversation for years. The stock market's continue to make highs. The economy has continued to hold in. The biggest problem we got right now in America is you can't get through the airport. That's the biggest problem. And everybody wants to travel. Everybody's trying to move around. Everybody wants to spend. Everybody wants to have a luxe life, or at least some type of affordable luxury, which is travel. And there's tons of demand. That tells you that the economy is still very active. This weekend in Chicago, by the way, was nuts. It was absolutely nuts. I could barely even move around in Gold Coast. It was crazy. The street was just packed. Now, that's because it was 60 degrees, and you don't really get a lot of that in March in Chicago, but still. By the way, this is all happening as Bitcoin is range bound off of its big sell-off. The dollar tried to ramp up and reverse. So a lot of things are just staying under control. And I generally think that's a positive situation. So again, I'm a little bit stubborn still, but I remain optimistic. I'm keeping the yellow lights on. I'll be quick to flip it red if it seems like we're going to go back down into the negative gamma territory and spike volatility. But that's the other thing too, is if you look at VIX, VIX tried to make a move above 30, couldn't, so the VIX now is range bound as well. And it just again, when you get to that he said, she said type of speculative trading, that to me strikes me as an over trading type of market because you just don't have expertise on geopolitics. People want to sound so darn smart. The top two things that people want to sound smart about in this world when they go on TV, trust me, I've been interviewing people on TV for a decade, is geopolitics and stagflation. Everybody thinks they're the smartest guy in the room on geopolitics. Everybody thinks they're the smartest guy in the room on stagflation. I can promise you, none of them are. Joel Hawthorne, what's up? Good to see you, sir. How are you? Thanks for coming on the show.
Oh man, thanks for having me, man. I like to consider myself a novice with geopolitics.
Well, yeah, I mean, You know what? I'm glad I wanted you to be on here today, Joel, because we always like to make poker analogies when you and I are talking. And I think the poker analogy in this type of market is people who are just seeing every flop. They're over trading. They're trying to get into too many hands. They're trying to make too many exploits. And I feel like that is just the riskiest trading environment there is. What's a lot less risky is generally owning stocks for the long term because earnings are go up, and taking high probability options trades. So, I think there's a lot of people that are getting mixed up and are overly sensitive. And when the market's overly sensitive, it makes me think vol's too high.
I couldn't agree with you more. I agree completely. I think it's one of those things that using poker, what is your pre-flop range, right? What are those premium hands before you see a flop? And I think this morning, the news that came out of the war with Iran right now, I think this war's been going on for about 25 days or so, was that there was some optimism that this may be winding down. We saw futures exploding to the upside. We saw oil crashing down. And I think right now, I think that was something that really kind of caught a lot of people, maybe by surprise. Did I think we were probably going to get a bounce today? Possibly, especially with Friday's action. But I don't think anyone could have predicted that news headline, and then obviously the reaction that we got before the cash opening bell. But I think that even leads into more of the conversation why the risk radar is yellowed, right? Because if we're gonna continue to, if you would, have this movement, if you would, by every headline, when does the market get exhausted from that? When does levels really matter, right? And then I think that's what we're seeing by today, a bit of a pullback today. We saw some reverting back to some lower price action. And then we've seen a bit of oil recover, right? We see CL watching it trade right around 87.71 or so right now. It's still down about $10 on the day, but this thing opened at about $100, and I'm talking about the futures right now. Of course, and this thing is open about $100 and maybe even traded about 101. So we could possibly see on every single headline, on every single tweet, every single just like knee-jerk reaction, we're going to see stocks perform, and we're going to see some of these commodities like a crude and a gold. Gold is not to be ignored as well. Gold looks to be down about 140
Gold's getting
or so.
dusted.
Yeah. So all of this right now is just all, I think, reaction to that news headline we saw pre-market.
Yeah, gold's getting dusted pretty hard. And that one's tricky. Look, I got to say that I think I tried to warn people on gold a bit that the risk profile completely changed on this, completely changed. Once it started making exponential moves, once it started doing convex things, once you started seeing, guess who? The options guys take over gold. This became a different asset when you saw those super heavy flows going in there and real speculative activity. So that could be, because it's down on an up day for stocks, I don't think it definitely is worth watching, right? But in terms of I don't know, we might be able to recover just fine and gold gets blasted. People go, I don't need this anymore. It served its purpose. Maybe it's time to buy the dip on stocks.
I was thinking the same thing. I think even with some of the sell-off we've seen today in oil and gold, I'm not so sure that bulls need to kind of run for cover just yet. Maybe cut some size, maybe put on some more hedges, maybe some protection plays. But again, if this is all truly going back to that geopolitical kind of narrative, if this is all going to be about what potentially is going to happen in the near future, just think of the adverse of that, right? If this thing doesn't end soon, what happens to those same prices of oil and gold then? They revisit some higher price action. So I'm not really ready to throw in my towel just yet on oil or gold myself personally.
Yeah. Oil too, I don't pretend to have any real strength in my analysis on oil, frankly. I never really have that. I've warned people hey, be careful listening to me. Because I don't have a whole lot of thoughts other than buy an EV car. Seriously,
Right.
And Charlie Moon over at Prosper last week was telling us about the solar stocks that were looking pretty good. Tesla's caught a bid. Lucid might be stabilizing off the lows. I kind of like those types of trades here. It does remind people that at least you don't have to deal with the volatility generally of oil as you do in electricity. But WTI, hitting $85 today and erasing 6 days of range essentially in one candle. I think that's probably pretty encouraging overall, Joel.
Yeah, definitely. And I mean, I like your approach. I like you mentioned electric. I think you mentioned Charlie Moon, who's really a sharp guy as well, talking about some of the solar stuff. I think the commodities, it's tough to be very extremely knowledgeable in all arenas, right? Back in the day, at the Board of Trade, you would see a lot of guys with that gold badge, and that means that they could go in every pit on the floor and kind of get and trade. And I think for a guy like myself, I kind of like to stick to what I usually am like consumed with every single day, and that's largely equities. But when you do see the action, when you do see the implied vol, when you see options are juicy, sometimes I do stick my toe in the water. I look around, and right now I'm looking at ExxonMobil and Chevron and looking at those two, kind of looking at that from an oil perspective, just to kind of see if things can kind of play out there.
What a great chart in Exxon, by the way, and Chevron, both holding in today. I think, too, I'm totally on board. This is what I will say, is that if you are really worried about oil and the implications of it, just like if you're worried about AI, best way to hedge it, buy AI companies. Best way to hedge oil, buy oil companies. Last week, we had a guest on from Horizon, their ETFs, one of their dividend ETFs, packed to the brim, full of energy stocks. So you get income from there. If you're an options whiz, you can figure out how to expand that even more with options. But even if just buying the stock, having the dividend that comes attached to a lot of these energy names, and then not having necessarily the commodity beta, the commodity volatility, because Chevron and Exxon, they're just happy as clams. Anything, it's not like you have to stay at $120 for them to be happy. They're happy anything above 70, basically, according to Billy Bob Thornton, a landman.
Absolutely. I mean, looking at these charts, you got Chevron right now trading about $204 a share, ExxonMobil trading about $1.60 a share. If you kind of wanted to go in that arena, you can go there. You don't have to worry about the ETF USO. You don't have to trade the futures in CL. You can kind of go in this arena and be a participant and maybe do some hedging and still be a part of some of these equities that we're seeing that are really getting beaten up on a day-to-day basis. So I think a bit of a hedge there, a bit of just kind of having a balanced portfolio right now would be the wisest thing to do. Because keep in mind, it's still just March, right? You mentioned having great weather. You mentioned travel. I was at O'Hare on Sunday morning, and it was brutal. Looking at the security line at O'Hare, it was very brutal, man. So people do want to travel. Again, playing the oil trade, you can't ignore airlines, right? That's another side of that business. So there's a lot to be said here. But even going kind of back to that poker analogy and kind of bringing it full circle, right? As traders, if you're truly a trader more so than an investor, some of this could be EV, right? Some of this, if you're a trader, could be good EV for a trader that wants to trade strong technical levels, and then pairing that with option flow and stuff like that. I know Spot Gamma does a lot of good stuff with that. So this could be some positive EV for a lot of guys.
I think if you're using options, capitalizing on elevated VIX, putting on high probability trades, looking at things that we've talked about that include generally collection of premium, maybe spreading those iron condors out to embrace the downside a little bit, or putting a little bit of skew in there to make them a little asymmetric, but generally capitalizing on the market largely staying in this 300-point range. I agree. There's definitely ways to try and to win here, to find expected value. But I think trying to pick an overall direction and think that this is going to break one way or the other, it's just so risky, man. Because what happens when you're seeing a bunch of flops? It means you're looking for action. It's a great time. But usually it goes your way because your six high flush loses to a jack high flush.
Absolutely, absolutely. You
get yourself in trouble.
Yeah, man. Yeah, man. If you're always in the pot, that means you're probably playing too many hands. You need to kind of sit back. And man, the most you have edge. You have a likely edge when you're in position. You're seeing too many cards. You're out of position. I think right now, based off this morning's headlines, the real question is how many people were in position, right? I don't think anyone. And then the shocker was we were down. The market futures were red uh, late in the, like, I would say probably about 1 a.m., 2 a.m. Futures were red. We were probably down 50, 60 handles in the ES. And then by the time we probably got to about 5, 6 a.m., I mean, we were skyrocketing to the upside. So markets were definitely weaker to start out.
Yeah. No,
I
for
don't
sure.
think, I don't think anybody, I don't think anyone could really predict the price action we saw in futures this morning. I just, maybe I didn't, that's for sure. I can't, I can't say, I'm not going to lie and say I saw that.
Yeah. Joel, someone in chat is talking about bond volatility, and I get that. I respect that. Obviously, bond volatility is elevated here. But again, like I said, the whole stagflation argument has just been a really tricky one to trade and generally has not broken the way many people thought it would. And bonds just can sometimes give false signals. People a lot of times use bonds to, in my mind, kind of confirm their biases a bit. Bonds can sell off for good reason and bad reason. Maybe they've been selling off for bad reason, but there also has not been a lot of bad economic news. So, and also, by the way, it looks like we are going to get some cuts. Just pulling this up real quick here. Number of rate cuts in 2026. I know maybe it's dropped from possibly 2, but 2, according to Kalshi, was always at 1 and 5. Was always at 20%. So 1 is just basically moving up. I mean, 0 is moving up too. But I think that overall, you're probably going to get at least 1 this year. And I don't see them not doing this based on what I heard from Powell last week.
I agree with you. It looks like we are projected to get at least 1 rate cut. And also, too, I think, and this is, I know I agree with you about bonds. There can be both sides of the fence to decide why bonds could be under pressure or not. And I think that has something to do with a bit of a changing of the guard, right? I mean, over the past several years here, we're talking about crypto money. We're talking about the resilience of dip buyers. We're talking about the short dated options flow that comes in that really does build a narrative every single day, right? Like it's one thing to say market today, like we've been range bound essentially since the rally this morning. But keep in mind, that's just today. And really for a large part of what we've seen, and even in our range bound market today, we're still probably maybe 30, 40 handles off the highs today. So
yeah. It's a battle.
So I mean, it's a wider range and there's still a lot of opportunity. So I think taking all that into account, I don't want to discredit bonds. Obviously, there's a lot of paper in the bond market. But I do think there is a bit of a broader scope, a bigger narrative on an intraday, on a day-to-day basis.
Yeah, no, I think it's a very fair point. I think that this dust will basically settle and then the answer for bonds will follow. By the way, since we're in Kalshi, just real quick, U.S.-Iran ceasefire by end of March, 19%. It crosses above 50 by April 30th. So, but that has come down. But yeah, you're still looking for the market, hopefully, maybe a month it's got to deal with this or so, at least according to Kalshi, but obviously those are moving as fast as anything else. Joel, thanks. Great stuff. You the man. Appreciate that very much. Good thoughts, good perspective as always. Joel Hawthorne, professional trader here in Chicago. Thanks for being on the show.
Thanks for having me.
You got it. Great stuff. Joel Hawthorne. All right, coming up, we got a short break. Then Jeff Garbaz joins me from Market Rebellion. He's got some interesting stats, giving you some perspective on the S&P 500, what we're seeing in options and more. Be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, welcome back to the show here. We got stocks holding on to a pretty decent bounce. Certainly has been a fight, but the S&P 500 right now up 1.5%. Almost 6,600 on the nose. Pretty much where we're at right now. So holding that support and not too far off the highs. 7,000 though certainly feels a little further away than it did a couple weeks ago when we were closer to the midpoint of that range. Still, all things said, 5.5% off the highs. All-time highs of 7,000. And that's a monster rally off of the tariff low, which is still a 32% gain. So I guess forgive me if I'm not quite panicking just yet. Jeff Garbaz is joining us from Market Rebellion, doing some sleuthing through some of the S&P 500 history and some data. Jeff, how you doing, sir?
Good. How are you?
Doing good. You know, there's a lot of drama out there, international intrigue, wars, and more. But, I mean, we're only 5.5% off the highs. So what does that tell you?
Well, we can look at it two ways. We can look at it from bear markets from 1980 forward, or we can look at the returns of the S&P since 2009 forward.
Okay.
So I would like to look at it from 2009 forward first, because it tells us something really interesting about what's going on right now.
Okay. So 2000, looking at what? Sell-offs or what type of data? Where do you start?
Do you have the chart?
Yeah, I got two of them here. Yeah, let's pull it up here, right here. All right.
That chart.
Yeah, take us through it.
That chart. So what this does is it takes from the very beginning of the year to the end of the year, the P&L, the absolute change, and then also the relative return against the Russell. So the S&P being up 23.45, the Russell was up more. So the S&P lagged by 1.81%. And then we had another up year, and then we had a down year. So we went 2 years up, then a slight down year. Then we went 3 years up, and then a down year. 2 years up, down year. 3 years up, down year. Our last really bad one that we had since the start of the 2009 period, the post-Great Financial Crisis. And so here we are now. We've had 3 up years. So you know what? If we don't break the trend, that would mean that this year's going to be a down year.
I see. So our pace of down years is we're kind of looking due.
We're due, yeah. I mean, look, it's either you go up 3 years or you go up 2 years. Since then, we've only had one really bad year. That was in 22. We lost 19.44%.
Yeah. Interest rate hikes.
Yep, that was
fighting inflation, wrangling it down.
So that's the first thing. Now look at this. The underperformance to the Russell, the worst was in 2010. The S&P made 12.78. The Russell turned in 25.30% during that year.
Yeah, big small cap bounce.
And then the best year for the S&P was 24, where it returned 13.31, and the Russell returned 10.02%. So that was the biggest laggard. But you can see lately, the Russell since 2021 against the S&P The S&P's beaten it pretty handily.
You know what's amazing about this? The thing that honestly stands out the most to me, Jeff, just simple, but is that COVID 2020 that we ended up that year was such a big rally. Just amazing that experience doesn't show up on the annual chart, right? Because it all happened in 1 year. That's just an amazing testament to resilience, but also what happens when we just dump money into the economy.
Can I show you a crazy chart?
Sure, yeah. Okay.
I'm going to show you a crazy chart here.
Okay, take me on a journey through a garbage chart.
So let's just do a quick share here.
All right, I'll make you full screen.
Okay.
What are we going to be looking at? Get us prepped here.
S&P 500.
Okay.
A monthly chart.
Okay.
Using our lovely DMA channel, displaced moving average channel, on a monthly basis.
Okay.
And then we put in the little oscillator on it.
How many years are you looking at?
Oh, I'm going back 20 years.
20 years. Okay.
So look at, to your point.
I'll get a 20-year monthly warmed up over here.
Here's the.
I got the 20-year monthly up for you here.
The break of the DMA, the pandemic, was such a short-lived event.
Yeah.
And then we went off to the races, got up to here at the end of 20, and then continued on for the rest of 21, and finished at an all-time high. And then came 22, the down year, where we kind of fell apart. But to your point, I mean, you look back at this chart, and the pandemic looks like nothing really happened, you know?
Yeah. 2 monthly candles. That was it. 2 monthly candles, a big ugly wick in the spring.
And then you got
April
back
ripped
into the
back.
channel, the next 2 months, and then you blew above it, and you never looked back until 22 when you're coming off of that high.
You know what's funny is this past year, the 2025 tariff sell-off and debacle, so similar, and actually even almost a more extreme kind of like candle in a way with that wild wick.
Yeah. So let's go to the other table that I shot to you.
Okay.
The very first one.
Okay.
So here you go. Here's your point. We had an up move from 22 to 25. S&P went up 71.77%. And then we dropped 18.90. Now, drop comments. A partial means we didn't go into a bear market. It was somewhere between, it was a correction, but it was more than a pullback. And look at this. 87 was the second year of me working. That was a drop of 30%. Then we had another big one in 22. That was a tech bubble, dropped 46%. Mm-hmm. Then the 07-09 period dropped 52%. Then we had the huge move from 2009 through 2020.
Yeah.
I don't know what's up. Oh, there we go. Leave it there. That's good. That's a good way to look at it. So look at the 9 to 20. Then we dropped 33%. That was a drop during the pandemic. And so we did last year, to your point, we had like the equivalent of the pandemic, we dropped 18.90%. And so the average duration of the bull period is 5 years. Okay. Looking at all these so this is year 4. In theory, we could go to year 5. We could get maybe another 2 years. Mm-hmm. But look at the subsequent drop on average. 28.
Once you get through that.
Yeah, 0.83. But what's amazing is lately, the last 3, look at the duration of the drop. 8 months, 12 months, 3 months before you got back to a new high. Mm. You know? Amazing.
Yeah.
So
somewhat short-lived in the last couple, 3, 8. You know, you had some real nasty, long-standing downtrends, you know, post.com, et cetera. And then, we had the epic long bull market that ended post-GFC with the COVID crash.
Right.
So give me the takeaway, Jeff, then right now, what did the stats say we should be at least be braced for understanding that maybe we are due this year? Or do we look at it from the COVID perspective, tariff perspective, and say, hey, this is just another freak out, rip this dip?
Well, I think Friday was a bad day. The fact that we closed below 650 on SPY, closed at 648 and change, but the cash S&P did close above 6,500, so we held that, and we're doing decently today after a rather heinous start to the day. Now, to me, I think the bigger question is, does the emperor have any pants on or not? And when's the market going to decide that matters? And what I mean by that is, this morning Trump came out and said, "Oh, I talked to the Iranians." Well, later in the day, the Iranians have come out and said, Trump didn't talk to anyone. And so, does the market continue to just blow that off, or does the market at some point consider that a more important deal? And we'll see. I mean, this week's going to be a good example because, in theory, tonight we should have started blowing up some power plants over in Iran, and now we push it back 5 days. And that's kind of like, we'll see how the market deals with this. Let's see if we get any more, missile shots somewhere. I think we're still in a very turbulent time period right now with respect to the market. And I think last week kind of showed it. If we break 650 or 6,500 decently, I think we go to 6,000 no problem. And then to go back to the prior show last week, and the big barf is fulfilled.
Yeah, we'll keep our eyes on it. Like the context for the history, telling us maybe we're due for the sequence of ups and downs. Like that perspective. Thanks, Jeff. Appreciate that.
Thanks a lot.
You got it. Nice. Like a Jeff Garbaz, Market Rebellion. Looking like perhaps, I don't know, we might be due 3 years in a row, but we have the COVID freak out, tariff freak out too. Like the technical work there. When we come back, Mr. Chris Brecher, who deserves some credit for putting the Cuba trade on our mind pretty early on, is going to be rejoining. Take a look at some of the travel stocks and what he's looking at here. 2:34 p.m. in Chicago. It's an up day for Las Vegas Sands. It's an up day for Wynn Resorts. Now, of course, the market's holding in as well too, and there's chaos in the travel space with the airlines not having TSA to support. But cruise lines are up, airlines are up. Got a nice little bounce there on the Jets ETF. We'll be right back. Chris Brecher joins us from Trading Nest TV next.
increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection. Seeking to deliver more than 70% of the upside, and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right. We are back here looking at some travel trades. One interesting chart, at least, is that of Jets, the airline ETF, trying to hold support despite travelers not getting much support. TSA on shutdown, and maybe ICE coming to the rescue. Sounds like a mess. Oh boy, Chris Brecher, what's up?
Not much. Luckily, the Cuba stocks. I was on, Tasty Live. I really like them.
Yeah.
And,
Hey, why don't you love Chicago Future Finance, baby?
I know. So
I love them too.
They're friends of mine. So
hey, you look like you were just in Cuba, Chris. Hold on, let me pull
yeah,
you up
I
on
know
the big
it's
screen
in here, but it's funny because they asked what do I like. I mean, what do I hate? And I just said, I like the Cuba stocks. And then the market's down like 8 million overnight. I'm like, oh, man, I need to hide under my desk. So I'm glad it popped for us with the RCL and everything. And,
so what's
now,
on that list? Remind me. You've got RCL on that list. You've got FLR on that list, right, for materials. Wynn Resorts, Las Vegas Sands.
Yep, and the thing about it is, the thing that's really bothering me is that oil's near the low and they've all sold off. I'm really surprised. I mean, it'll give you a headache of, is Iran negotiations? Is it not negotiations? So I'm trying to go on just price of everything. And I'll tell you right now, I'm really surprised. Like MasterCard sold off like 5 points. RCL coming back now, finally. I think that's because we talked about it on TV. But no, Las Vegas Sands sold off just now about 70 cents. Wynn Resort sold off at $2. I don't know why. So you wonder if those are great proxies for what we're watching. And, the overall.
I opened up TikTok this morning, and they were doing memes of Trump taking over Cuba as Dr. Evil. So it seems like it's
Were they really?
Yeah, it hit the the airwaves. It's hit the memes and the social discussion now. So
that was me. So
you were all over it. You hit it way early. I'll be honest. I was quick to get on board though because I want this to happen. Look, I'm not gonna lie. I would love for us to
That's what you
What
said,
are they doing down
yeah.
there? There's nothing. There's nothing innovative going on in Cuba right now. Now, I hope we don't mess it up. Go in there physically, but I don't think it would take much. I think
That's
anyway.
what we were talking about last week. Is it wouldn't take.
I just want
much.
selfishly. I want a casino in the tropics.
I agree with you, and
Easier
that's
travel
why
back and forth.
I still like Las Vegas Sands.
Okay.
They would really benefit, and also they probably went down also because of all the instability and people worried about going to Macau and all that. But you got to think if it gets more aggressive, this could go to that 56 area up there. And, don't forget Pete mentioned when he was on the show last week about the UALs of the world having the options go out September. They were seeing a ton of call activity. And that makes perfect sense of going a little farther out because it might take time for that to play out.
There was a headline as well that maybe some of these prediction markets are going to get clamped down on as far as sports betting goes. And by the way, maybe I'll take the opportunity here to say, not just because I'm in the backdrop of Cboe where they've said they're not doing sports, I like the prediction markets for the non-sports stuff because sports gambling is just Russian roulette, basically. But that being said, I'm all in favor of being able to bet on economics, politics, everything else, because I think it has more purpose, frankly. So this idea that maybe the prediction markets, which have just been essentially a vehicle for off-book sports betting, look, I mean, I guess go for it, regulators, if you think that that's the way to go. Keep it to the casinos, I guess, fine. That's the headline there. Gambling stocks rally as U.S. lawmakers target prediction markets. So I have no objection to that personally. I think it probably is the case. It seems like there's also folks on both sides right now of that. Republicans and Democrats seem like they both want to go after the prediction markets. So that's probably bullish for Wynn and LVS and everything.
Yeah, I was smirking because I wonder, that site Quiver Quantitative that tracks the Congress people? I wonder if they've been loading up on Las Vegas Sands and Wynn.
Oh, yeah, well, yeah, that's the other thing, too, that I also said is like, oh, you got a problem on politicians making money off politics? Well, okay, what do you think's been going on for 300 years?
Well, I'll tell you another thing interesting. You'll like this. This is right up your alley with the SPX. At 5:15 p.m. Eastern on Friday, Trump came out and said that there's some that they're at the near the end line.
Yeah,
and
yeah.
On the close on Friday at 5:15, the markets actually had a surge. You should see the option volume of the SPX 6650 call on Friday.
Yeah.
It just surged. Now, you might say that's triple witching, but it looks real unusual to me. The 6600, the 6650, just massive volume on Friday.
Nice tease. We're going to hit that with Scotty Bauer coming up here into the close. You're right, because, I do think what happened around Expedia is a pretty big deal. Hey, Chris, to come full circle on the travel stuff, because thinking about what relates to sports gambling, what relates to the, the actual Cuba situation. Do you think Cuba's getting baked into here, really? Do you think that's what's going on? Or do you think if something actually happens, these are going to surge even more? What are the odds you think it's priced in there?
No pun intended. Basically... Yeah. I think that if something does happen, well, let's put it this way. I'm overall bearish on the markets because of just the developing top, but we could rally first. Don't get me wrong. So I don't want to, because we're oversold and there's a lot of negative sentiment. But if I'm wrong and the markets go up, even without Cuba, Las Vegas Sands could go to much higher, could go to 50. And to 60.
Wow.
And the way I look at it, it seems like it's developing a bottom, no doubt about it. So you see that line, and I know we can draw it in a lot of ways, but that downward sloping one is real close to breaking up. And if it does, you're talking about maybe filling that gap up at 60. So I'm thinking if the markets rally, that could go up. If Cuba happens, it could go up. And then you have this sports gambling thing that's pretty cool. And I don't mind going out to September and doing even more spreads. We already have on spreads, but I'm thinking of going all the way out to September.
Okay. For LVS?
Yes. And Royal Caribbean, we actually took a profit today on some broken wing flies. I want to get back into that as well. But you're right. I think that Las Vegas Sands is a better idea, because Royal Caribbean was $15 lower on Friday when Las Vegas Sands was only $1 lower. So I think the risk reward is better in Las Vegas Sands.
I got to say, I do like the chart. It's fun. I love those big sideways triangles that look like they are ready to break in one direction or the other. And that's what we've got on LVS. And then finally, as we wrap it up here, Chris, I'm going to pull up real fast the odds. I just had it up there. Will the U.S. invade Cuba in 2026? Currently at 24% chance on Polymarket. So if you think that's going higher, LVS with the, what was the trade structure you said you had real quick, Chris?
I would go into Las Vegas Sands. We have on something already So we have on a
What's
June,
that look like?
I'll just tell you as fast as I can. We have on like a June 47, like at 47 and a half, 55, 57 and a half.
Okay.
So it's like 370, and if you're 2 right, it's going to 5. But I'm thinking of rolling into like a September and going into a wider, like a 40, 50, 52 and a half.
Okay. Like that. Looking for upside in LVS. All over the Cuba trade. Thanks, Chris. Love
Yeah,
that
sure.
shirt.
Thanks for having me on.
Hey, where do I get that shirt?
I'm telling you, my wife tried to throw it away, tried to hide it, but
Women, what do they know?
Just let me know. I'm happy to well, probably if she throws it
order
away,
another
I'll
one?
send it to you.
Okay. All right. There we go. Thanks, Chris. Appreciate it, man. Looking for upside in LVS. On Cuba News, currently priced at 24% of an invasion. Wild stuff that we are talking about this year. Nothing off limits, I suppose, with this administration. Got Mr. Scotty Bauer on the line, taking us into the closing bell here. Scott, what's going on? We got 12 minutes left. Market is hanging in decent. We're up about 100 points, 97.
Yeah,
What do you
just
think?
shy. Yeah, it's this rally. We'll see, if it can remain. Obviously, as we've talked about, this changes minute by minute. And, something I want to talk about, which is so important for anybody that trades options, Oliver, is they have to understand what happens at expiration and what rights and obligations mean. That's one of the first things anybody that gets into options hears about rights and obligations. You and Chris were just talking about kind of that 6,500 line, and if you look at the 650 line in the in SPY, okay, at the close of the bell on Friday, on the 650 line, there were about 250,000 of those, okay, that had traded. So what happens? Well, that closed 648 and change. SPY closed. But then, as you guys were just talking about, and as we all know about, 15 minutes later, Trump put something out on Truth Social, and we saw this massive, massive rally. 90 handles, something like that in the S&Ps, right? So in the SPY, those calls, specifically the 649 and 650s, which were just out of the money, which theoretically closed at zero, right? Well, it was expiration day. And what many retail traders don't know and don't understand, and they must, is that on expiration day, you have until 4:30 Central Time to actually exercise an option that expired out of the money, or to not exercise an option that expired in the money. Okay. Now you can't.
I learned that the hard way.
You can't trade the option. So once we're at 315 in the option market closes, if you're short those guys, you're in trouble. Right. That's why I never leave a penny option out there. I just don't. I teach my students to do the same thing. Never leave that out there. You just never know of that risk. So what happened was we saw that massive, massive pop, and these holders of the 649, 650s, if they were paying attention, had the opportunity to exercise them by contacting their brokerage firm. You have to actually contact them, fill out what's called an exception notice, let them know you want to exercise those, get your long SPY at 649 or 650, and then go sell it in the aftermarket when it ripped higher, as opposed to those calls just going out worthless. Now, those holders who were short the 649s and the 650s and said, oh man, I escaped, no worries, I'm going to have a nice weekend. Well, they could have gotten assigned on those been short by 649, 650 coming in this morning and really took it on the chin. So it is so imperative that especially retail traders understand rights and obligations and what can happen after hours, especially on an expiration day.
Great point. Learned that one the hard way myself a few times, where I didn't realize that I had to close that out, and then I'm expected to buy 100 of these contracts. All right. Hello, Mr. Schwab. Can you throw me a bone on that one? Can you close that out for me?
Can you help me out on that one? Exactly. And so many people, so many retail traders, they want to squeeze literally every last penny, every last 2 cents out of a short position, right, at expiration. Now, if something is 20% out of the money, okay, maybe that's a different story. But when you're that close to a strike, and I've been doing this for 35 years, I am not letting those things, if I'm short them, I'm just not letting them go, unhedged, or I'm gonna close them out. So word to the wise out there, be careful on the next one.
Yeah, I love that. No, it's important. I think also, too, there might be something here, Scott, that's worth kind of thinking about with the volatility of the last, this session and Friday. To have such a big down move on a big expiry and then come back and ramp it up on the Monday after, I don't know, maybe there's something there.
There definitely can be. And if you look at the ebb and flow of the market over the last several weeks with, the escalation of what's happened in Iran, the market has moved more on tweets or Truth Social posts than on anything else. It has not really moved on fundamentals. It has not moved on technicals. Sure, you can say that, SPY S&Ps held at their 6,500 levels for a while, or 6,600 levels for a while, and then broke through. But I am telling you, Oliver, in 35 years of doing this, I have never been in a market, and everybody will say the same thing, where we see the market literally trade on social media posts, minute by minute. Sure, we had the meme stock craze, and that was kind of in there, but not like this. It is a great market to trade in. At the same time right now, it can be a very dangerous market to trade in if you really don't understand the dynamics of what's going on.
I mean, full circle. That's how I started the show. My poker analogy was that this is just over trading, overplaying. There's a lot of, unless you're taking advantage of volatility and putting on the high probability trades, we've been trying to structure, respecting the range, trying to think that you've got some strong understanding of either Trump or Khamenei or whomever is like, good luck, dude. Good luck. You're just going to get whipsawed back and forth.
I mean, all you have to do, those that weren't, watching the market on Friday after the market closed, if you were up early this morning, and I don't sleep, so I was up early anyway, it was 5 o'clock, and S&Ps were down 40, 50 points, Dow futures were down 300, NASDAQ, whatever, and literally within 2 minutes after the latest Truth Social post, we saw that everything flipped, and SPOOs rally 100 points, and the Dow rally 1,000 points. We've never been in an environment like this, and so you just need to be careful. You really, really need to be careful.
Scott, I do wonder the fact that we got this local low on a big expiry day. My thought on just equity volumes in general is that you can't read too much into them because volumes generally just go up when the markets are down. That's the relationship. But I do like to have that kind of, I have some belief in that idea of volume confirmation as some sort of traditional technical analyst would describe it. But I think the modern day version of that is like options confirmation. So on the expiry days, when you've got so many opportunities for people to decide on a position, the fact that we hit our low there, I think that maybe augurs to some extent the possibility that maybe people took that as an opportunity to close out. They have been waiting for this market to break. It finally did. And maybe that's kind of what we needed to reset a little bit. Maybe we're changing the news flow now to where maybe just no news, we could stabilize.
There's no question about it. We need a period right now of just no news. What we don't need is the flip-flopping of news every 20 minutes, every 3 hours, whatever it is. That's what the market is not really set up to trade on. It isn't. And at that point, you bring in your poly markets, you bring in your Kalshis, and you just, you make a bet, right? That's not what option trading is all about. So going back to your point of, if you have a thesis, if you have a position you want to put on, that's fine. Do it with conviction. Do it and make sure that you are completely risk defined. So one of those reasons, you and I have talked about those iron condor signals over the last couple of weeks. They've killed them. And they are completely risk defined. So if you did have a blowout move, like what we got after the market or today, and it does go through a strike, okay, you know what your risk is. You can't be trading in this market without being completely 100% risk defined.
That's the thing too, is I think you can, if you have a directional view, then you just shift your strikes down. You asymmetric, a little bit if you need on that iron condor, right? Like you can just shift it down. You can adjust things. That's the beautiful thing about options. It's a choose your own adventure. So you don't have to get caught up on picking the beginning or end of World War III, these highly binary cataclysmic events. It's just now maybe you realize that the range is more like a 66, to a 68 rather than a 67 to a 69.
Exactly, right? We always have to have that shift. We always have to adapt. You can't be, have the blinders on and be so laser focused and think that you actually know what the market is going to do, because the market is dynamic and it's always changing that way. And we have to adapt to it.
Yeah. The big candle on VIX today too. The fact that, we tried to push 30 and then faded back down.
Yeah. I saw it, pre-market when we were down before that post. We actually went over 30.
Yeah, and crude reversed. So I don't know. There's some hopeful things in here. There's not a lot in the way of economic data this week, and a bunch of stuff is delayed anyway. Scott, any other thoughts on what to look for here this week?
Yeah, I mean, the news flow absolutely is out of Iran, because you said it is a very light economic data week. And, we're really towards the end of earnings season here. So got to still watch the bond market. The bond market has been telling the story. We've talked about it. I mean, to see what that 10-year did is just crazy. So got to watch the bond market.
Yeah, bonds definitely have been a focus. A few folks in the chat talking about that as we got the decent sell-off. But at least today, some stabilization there to some extent. Nice job on the expiry analysis, taking us right there into the bell. Scott Bauer, Prosper Trading Academy. Scan the code to work with Scott and the team. Appreciate it, Mr. Bauer. Have a great afternoon.
Thanks, Oliver.
You got it. See you, Scott Bauer at Prosper. Thanks to the crew. Thanks for the guests. Everybody who tuned in on the special Monday show. Live tomorrow and then Wednesday. Have a great night.